All right, thanks everybody for coming along this afternoon. I'm here. My name's Cameron Kusher. I'm the Director of Economic Research at REA Group, and I'm here to give you a West Australian housing market update and outlook. But what I'm actually going to start with is a bit of an economic update and outlook before we delve into what's happening in the housing market. There's the opportunity at the end of this session to ask questions. So if you have any questions, please pop it into the chat or the Q&A function, and we'll try and get to it at the end of this presentation. But in the meantime, let's get into it and have a look at what's happening. So at a national level, economic growth is extremely weak at the moment. You can see here that the economy grew by just 1.1% over the past year. It only rose by 0.2% over the March quarter. Over the last 30 years, economic growth has averaged 3.1%. So the growth has been less than half the 30-year average over the past year. If we look at things on a per capita basis, the economy has shrunk for each of the last 4 quarters. And as far back as we have this data, which goes back to about 1974, we've never seen 4 consecutive quarters of per capita GDP shrinkage, which really highlights, again, how weak the economy is, but also how much the growth in the economy is being driven by the rapid rate of population growth we have here in Australia at the moment. So it's a real challenge for the economy, and things are quite weak out there at the moment. The national accounts, which includes GDP, also has some information on what households are doing, and the household saving ratio is sitting at 0.9%. Was a little bit lower than that a few quarters ago, but to give you some context, during the pandemic, you can see we were saving about 25% of our household income. Why? Because it was really hard to spend money during the pandemic. You couldn't travel overseas, particularly somewhere like Western Australia. You couldn't really travel interstate. If you're in Victoria, nothing was open, no schools were happening, so people weren't spending money. As those restrictions fell away, we saw a rapid increase in household spending, and we saw households saving less. Now, households are still saving more than they're spending, but they're saving the lowest amount they have since before the global financial crisis. So households are saving a lot less, and they're consuming a lot less, as you can see on the right. Household consumption grew by just 1.3% over the past year. Household consumption makes up about half of all economic activity in the country. And again, consumption is way below the longer term average rate of growth of 3.2%. So households have really tightened their belts as interest rates have gone up, as inflation has been strong, and as the cost of living has increased dramatically. That's basically been the household response to date. If we have a look at inflation, we know that inflation's been a big headache. And over the most recent quarter, headline inflation, which is everything, or underlying inflation, which is how the Reserve Bank prefers to look at inflation, it strips out some of the more volatile items. Both of those came in at 1%. Over the last year, underlying inflation has been 4%. Headline inflation has been 3.6%. Both are outside of the target range of 2 to 3% and have been for several years now. It's a bit weird what's going on at the moment. So state governments are offering energy rebates. There's a whole range of cost of living relief, and that is probably going to see headline inflation fall back into that 2 to 3% target range in the next few quarters. In saying that, though, once that support is removed, we're probably going to see a rebound of inflation. So the Reserve Bank is likely to look through that and keep focusing on underlying inflation, which is likely to remain outside of the target range for some time yet. And we'll talk more to that as we go through. In terms of where the inflation is strongest, you can see that services inflation is much stronger than goods inflation at the moment. This is something we're seeing right across the world. It's not unique to Australia. Services inflation is proving to be much more persistent than goods inflation. And if we look at where the inflation is particularly strong, insurance and financial services, which is a service, obviously, and it's kind of an essential service. You could not pay insurance, but it wouldn't be best practice to do that. Insurance costs are up 8.2% over the past year. Why? the cost to rebuild a house has gone up substantially, so home insurance premiums have increased, but also the regularity of natural disasters has increased. So premiums just generally are rising quite a lot. Education has gone up 5.2% over the past year. Inflation's been high. HEX is indexed to inflation, so we've had big education increases. We've also got really strong demand for education services from the international students coming into the country, which has pushed up the price. You can see housing inflation has come down from where it was 12 months ago, but at 4.9% is still high. Previously, that was being driven by the cost to build new housing. Now it's more being fueled by really strong growth in rents. And alcohol and tobacco is indexed to inflation, excise twice a year. So that's why, because we've had high inflation, alcohol and tobacco is also seeing strong increases. Now, none of those things will really be impacted by higher interest rates. That won't bring that inflation down. In fact, it would probably drive up insurance and housing inflation as well. Unfortunately, though, interest rates are the only tool that the Reserve Bank has, and it is being effective at driving inflation lower for certain things like recreation and culture. You can see there furnishings, household equipment, clothing and footwear. There has been a big slowdown in the inflation in those items as the higher costs have meant that fewer people are demanding those things. So as interest rates have taken off, the cash rate has increased. The cash rate's now been on hold at 4.35% since November last year. But to get to 4.35%, it was a very rapid increase in interest rates over a very short period of time. And at 4.35%, interest rates are the highest they've been in more than 12 years. Now, the expectations are that there aren't going to be any further increases in interest rates, which you can see on the chart on the right, which is the futures for cash rates yield curve. Now, this is not always right. And if inflation does come in much stronger than anticipated when we get that next read at the end of next month, we could potentially see the Reserve Bank having to lift interest rates again. But at this stage, the base case is steady interest rates with cuts coming in the middle of next year. Now, that's quite a different story to what it was 2 or 3 months ago, when it was looking like interest rate cuts and interest rate relief for mortgage holders was coming by the end of this year. So it's been pushed back about 6 months, and it's going to be very interesting to see how households respond to that, particularly those lower income households that generally were really hanging out for those cuts that are now further away. In terms of the labour market has been one of the really strong areas of the economy over the last couple of years. The unemployment rate has increased from 3.5% to 4%, but it's been pretty consistently below 4% for the last 2.5 years. It hadn't been below 5% prior to that period since before 2008. So it shows you just how tight the labour market is. The participation rate is pretty much at record high levels. Two ways to read this. The tight labour market has attracted more people into the workforce, or the high cost of living has meant that people that previously didn't need to work now need to work. And the truth probably lies somewhere between both of those. What we are seeing, though, is the annual growth in the number of people employed is starting to slow. It's still above the long-term average. But what we are finding is much stronger jobs growth for part-time jobs than full-time jobs. And that's a sign that there's a little bit of slackening of the labour market, which we do expect to continue over the coming months. You can also see that the underemployment rate and the underutilisation rates are rising, still very low on a recent history basis, but the underemployment rate measures the percentage of people that are employed that want more hours. So that could be someone part-time that wants to be full-time, or it could be someone that's part-time 20 hours a week that wants 30 hours a week. And the underutilisation rate is underemployment plus unemployment. And you can see both are clearly trending higher. On the right there, you can see the annual change in the hours worked, which is just 0.6% higher over the past year. Again, reflective of that stronger growth in part-time employment. You've got more people working, but you've got more people working not 36 hours a week. So that growth in hours worked is really slowing down. We do expect that the labour market and the unemployment rate will continue to drift a little bit higher, but it's still way below where it was before the pandemic came along. You can also see further insight into the weakening labour market. Now, the number of online job advertisements is still extremely high, but it has come down 21% from its peak. You can see in Western Australia, it's down 9% over the past year. And what's happening is businesses, the economy's weak, businesses are doing it a bit tougher. So a lot of businesses are going, well, do we really need that job? As people leave, maybe they don't re-advertise those roles as people leave and they think we can get by with who we've already got here. And I think we'll see more of that and we'll see job advertisements continue to trend lower. But the tight labour market has led to wages increasing. So the wage price index peaked its recorded peak annual growth in the December quarter. It has at 4.2%. It slowed to 4.1% over the March quarter. But you'd have to go back to 2009 to see wages rising at this sort of pace. The good news is wage growth is now, for the last 2 quarters, stronger than inflation. So households are seeing real income increases for the first time in about 3 years and don't feel like their pay packet, at least right now, is keeping up with inflation. So that's a really positive step. And we do expect that wage growth is going to continue to be stronger than the annual change of inflation. Moving on to the lending environment. So new lending is up about 25% over the past year. Refinancing's up about 16%. You can see that the value of new lending is much higher than refinances. Why has refinancing slowed? Because the bulk of the people that were on fixed rate mortgages rolled off fixed rate mortgages and had to refinance over the first half of last year. It then slowed dramatically over the second half of last year and into this year. And then you've also got that interest rates have not been changing as regularly. So people haven't been shopping around and trying to refinance as often as they were a couple of years ago. In terms of new lending, you can see that investor lending has seen the biggest upswing. It's up about 33% over the past year. Lending to subsequent buyers, so that's upgraders and downgraders, is up about 18%, as is lending to first home buyers over the last 12 months. But you can see the value of lending to investors is more than double the value of lending to first home buyers at the moment. One of the challenges in the housing market at the moment is we're not building enough new housing. And there's a lot of speculation as to why this is. A lot of the time, planning is the thing that gets pointed to, and planning is certainly a problem. But one of the big problems is just how much the cost of actually building a house has gone up. So you've got 3 components here. You've got inputs, which are all of the materials that go into building a home, and you can see those on the right there. Since the start of the pandemic, input prices for housing are up about 34%. There has been a deceleration of growth, but prices are still up 1.3% over the past year. Then you've got outputs, which is the civil works on a project and then ultimately building the house or the other residential, which is a unit. So the output for houses, those costs are up about 45% since the beginning of the pandemic. And you can see that the annual rate of growth is actually ticking higher, up 4.3% over the past year. Similarly, for other residential, it's up 7% over the past year, ticking higher, although those prices are only up about 25% since the beginning of the pandemic. But what this all means is all of those costs get passed on to the person that buys the property. And there's always a premium for a brand new home over an existing home, but that price premium at the moment is much larger than it typically is. So for developers, it's a bit of a hard sell to convince a buyer to purchase a brand new home as opposed to an existing home. Now, WA is a bit of a different story because there's hardly any stock on the market. At some point, I think people just give up trying to find an existing home and go and purchase that new home. But certainly in other markets, it's a much tougher slog to get new homes sold. And as a result of that, we can see that dwelling approvals are extremely low. So annual dwelling approvals are the lowest they've been in about a decade. And of course, the federal government wants to build 1.2 million new homes over the next 5 financial years, which I'm yet to find anyone in the industry that thinks that's going to happen. And with material and construction prices up so much, with labour prices up so much. But the other big factor limiting new housing construction is interest rates. Interest rates the highest they've been in 12 years, which means developer and construction finance is high, which means your margins are slimmed, but also then it's harder to find the level of pre-sales you need to go ahead and start constructing new housing. We can also see this playing out when we look at commencements, which are also at a decade low. Now, there's still a lot of housing under construction, but this is mainly due to the fact that there's a lot of projects out there that have been abandoned or delayed, and just generally finishing a project takes a lot longer now than it did before the pandemic because we have had all those material and labour shortages. Unfortunately, though, we need to be building more housing because the population is increasing so rapidly. So at a national level, there's two components of population growth. There's natural increase, which is births minus deaths. Over the past year, natural increase has been at a record low. So we've got an ageing population having fewer children. Net overseas migration has been at a record high. So the population of Australia increased by about 650,000 people last year. About 84% of that population increase came from overseas migration, who mostly students coming here temporarily. So at least initially, what they're looking for is rental accommodation. And that necessitates you to build a lot more housing. And we just haven't been doing that. So that's exacerbating in Perth price increases, but also rental increases that we're seeing. So let's have a look at some of these figures specifically for the West Australian economy. So the unemployment rate in WA is much lower than it is nationally, 3.6% compared to 4%. That 30-year average unemployment rate is much lower in WA as well at 5.4%. WA is a bit of an outlier. You can see the annual change in the number of employed persons is up 4.9%. Remember, nationally, it's up about 2.2%. So much stronger employment growth. And we're still seeing strong employment growth in the full-time space, not just in the part-time space in WA. You can see that over the past year, there's actually been a drop in the underemployment and the underutilisation rates, and they're still very low. And hours worked is up 3.2%. Compared to that 30-year average, 2.3%. So the number of hours worked is gathering pace. So the economy and the labour market in WA is comparatively very strong at the moment. If we look at the lending environment, so you can see here that subsequent buyer lending is up 29% from a year ago in WA. This is all based on value. First home buyer lending is up 20%. But it's the investor space where things have gone absolutely gangbusters, up 70.5%. Why? There's a few reasons why. Rental returns are really good. Prices are rising really rapidly. But also, if you go to somewhere like Victoria, the state government there has made investing in Victoria much less attractive. So a lot of people from Victoria and places like New South Wales are looking at WA and going, firstly, the cost of a house is a lot cheaper in WA than it is in those states. Secondly, the rental returns and the price growth at the moment is really attractive as well. So that is getting a lot of investment into the state. But we're still not seeing a lot of new housing being built. So the number of commencements is still extremely low, particularly for units, but also for houses. There's still a lot of housing under construction, but you can see it's starting to trend lower at the moment. And at the same time, population is growing really strongly. So at a state level, you also get net interstate migration. And net interstate migration over the last few years in WA has been really strong. And this is because there's been fewer people leaving WA, but there's also been more people moving to Western Australia. And at the same time, you can see net overseas migration has also been at record high levels. So when you've got a lot of people migrating both from overseas and interstate into your state, you need to be building more housing for them. And unfortunately, that's not what's happening in Western Australia at the moment. So what does that mean broadly at a national level for the economy this year? We have had weak economic growth over the first quarter of this year. We do think the second quarter of the year will see a continuation of that weak economic growth. Things will start to improve over the second half of this year. In saying improving, economic growth is still likely to be well below that 30-year average. Why? Tax cuts have been broadened, so more people will get tax cut relief. There's obviously a lot of subsidies that state governments are doing as well. Inflation, whilst it's not back in target, it has eased. And also, with the expectation of interest rate stability, the impact of those interest rate increases we previously had will fade as you get further away from it. So things will improve a little bit. Inflation, as I said, headline inflation will probably fall back into the target range, but underlying inflation is likely to remain outside of that target range. And as a result of that, it looks like interest rates cuts won't come till next year, as opposed to late this year, where a lot of people were expecting even just a few months ago. The labour market probably does weaken from here. We start to see job creation slow and the unemployment rate drift higher. The reason for that is some of the shortages we've had will wane, but also businesses will respond to the weaker economic conditions by slowing down their hiring intentions and reassessing the open jobs that they have. Wage growth, as I mentioned, has likely peaked, but we think that wage growth will continue to be stronger than inflation. So that's good news for households. Unfortunately, housing construction looks like it's going to be even weaker this year than it was last year. And last year was an incredibly weak year. We desperately need more housing. But as I spoke to, there's a lot of challenges with delivering more housing in this environment. And at the same time, population growth looks like it's probably peaked, but it remains well above long-term levels. So we need to be building a lot more housing. We just aren't able to build enough at the moment. So let's have a look at what's happening in Western Australia. Over the last 3 months, prices in Perth are up 3.6%. You can see in the southwest, price growth has been 4.9%. Southeast, also really strong price growth. It's the inner suburbs where we've seen relatively weaker growth. And then regionally, things are quite mixed. You can see the wheat belt and the outback south has seen prices fall over the last 3 months, whereas the outback north and Bunbury has seen prices increase. Now, last 12 months, prices in Perth are up 20.6%. The southwest, again, strongest market, followed by the southeast. Regional WA prices are up 11.7%. Some comparisons. So prices in Perth are up, say, 21%. In Adelaide, prices are up 14%. Brisbane, 13.5%. Sydney, 7%. Melbourne, prices are only up 1%. So prices are comparatively booming in Perth compared to everywhere else. What I would say is, though, it does look as if the annual rate of price growth has probably peaked. And I don't need to tell you, yes, the Perth housing market is booming at the moment, but for the best part of the last 15 years, prices went nowhere in that market. So I'm assuming if I could speak to you all, you would say that this price growth is well and truly long overdue. And I can remember back in 2005 where momentarily prices in Perth were actually higher than prices in Sydney. So a lot of this has to do with the relative affordability of Perth that has happened because prices haven't increased for such a long period of time. If we look at houses and units, so house prices in Perth and in regional WA have risen at a faster pace than units, but unit price growth in Perth has been at a cracking pace as well of 16.2%. Southwest house prices are up 25%, as are southeast. The market where things are really lagging behind is the inner suburbs, where house prices are only up 9% over the past year. And if we look at the past 5 and 10 years, again, this shows you, yes, the market's been very strong over the past 5 years, but taking a longer term perspective, things have been very weak. So over the past decade, prices have only increased in Perth by 36% and only by 32% in regional WA, whereas over the last 5 years, prices are up 65% and 59% respectively. So yes, strong growth recently, but take it out a decade, and it has been, outside of Darwin, the weakest growth of any capital city in the country over the past decade. This chart here just looks at the premium for houses as opposed to units, and not surprising, in the inner suburbs, it's getting extremely expensive to buy a house in Perth, and the median house price is 237% higher than the median unit price. And I think this just speaks to the fact that there is a big push in a lot of parts of the country, not so much in WA, but certainly in some areas, that we need to get more density into those better located inner suburbs in order to allow people to afford to live in these areas because buying a house in the inner suburbs is just not something that a lot of people can afford to do given where prices are now. Which then brings us on to what's happening with the supply of stock for sale. So new listings in Perth and total listings have been extremely low over the last couple of years. The feedback I've got whenever I've gone to Western Australia is, yes, we'd like to sell, but what are we going to buy? There's nothing to rent and there's nothing to buy. And that's still a challenge in Perth. So the number of new listings is actually marginally higher than it was a year ago, 3.1%. But it is lower than the average for the 5 years for May over the 5 years to 2022, down 0.5%. Where we have seen a big increase in new listings is the inner suburbs and a more moderate increase in the southeast. In regional WA, much more varied, but generally only a moderate year-on-year increase in new listings. Total listings, though, there's not much. So when you start looking for properties to buy, there's not much on the market, and basically everyone is hanging out for those new listings. So there's a lot of competition when a good property comes onto the market. Total listings are down 23.5% from a year ago. Look in Mandurah, they're down 33.5%, whereas in the inner suburbs they're only down 8%. But total listings are 45% lower in May than what they were on average between May 2018 and May 2022. So it's just an extremely, extremely tough market because there is not much choice. And that's why you get 20% increase in prices over the past year. Sales volumes, they've been very strong for several years now. They are 3.8% higher than they were in 2023. You can see it was the best May for sales any year since 2019 this year. A 48% increase in the inner suburbs. Interestingly, 24% decline in sales in Mandurah. And even regionally, you can see outside of Bunbury, a relatively large increase in sales volumes compared to a year ago across each of those regional markets. And then if we look at our measure of demand, which is inquiry per listing, the number of inquiries per listing is at a record high. Now, we've only had this data back to 2019, but you're looking at 20.5 inquiries per listing, which is 75% higher than it was a year ago. Have a look at how many inquiries you were typically getting before the pandemic. You were getting about 2 or 3 inquiries per listing. So the market is vastly different to what it was before the pandemic, and even compared to what it was, midway through the pandemic. And you can see right across Perth and right across regional WA, the number of inquiries per listing is higher than it was 12 months ago. So the level of demand is still really strong. Problem obviously being that there's very little supply. And if we look at the median days on site, so in Perth at the moment, the typical property stays advertised on our site for 41 days. A year ago, it was 49 days. If we look at the average in May from 2018 to 2022, it was 74 days. So again, just highlighting how much stronger the market is and how much quicker properties are selling in Perth now compared to what was usual over that 5-year period. In regional markets, a bit more mixed. You can see days on site is higher in the wheat belt than a year ago. It's lower everywhere else. Things are moving reasonably quickly in Bunbury and the Outback North, but taking longer in the Outback South region. But, good market conditions. If properties are coming to the market at a reasonable price or someone's willing to adjust the price to meet the market, things are selling quickly. So where do we think broadly the market's going? So I think firstly, and my first point here probably doesn't hold as strong for Western Australia as it does for other parts of the country, given that, for 15 years prices went nowhere. But if we think about from the 1990s to where we are today, prices have gone up quite a lot, even in Western Australia. This has been driven by a few big changes. So firstly, interest rates fell from about 18% at the start of the 90s to nothing. As interest rates came down, borrowing capacities increased quite dramatically. People borrowed more and pushed up property prices. Credit availability, it became a lot easier to access finance through the 90s and early 2000s. Then we had the GFC. It's actually quite a bit harder to get credit now than it used to be because go to take out a loan, there's a lot of questions, it's very intrusive. You also have the banking regulator, APRA, limiting credit growth for investors, for interest-only borrowers, changing serviceability buffers. The serviceability buffer at the moment is 3%. That makes credit harder to get, and I don't think that's going away. And then you've also got employment participation. I talked about it being at record high level, mainly due to more women joining the workforce. As more women have come into the workforce, household incomes have increased, borrowing capacities have increased, and people have spent more on housing. One thing that is still driving demand for housing is migration, which is still strong, although it's becoming a bit more contentious. I think even if it were to be cut, we'd still see a relatively high level of migration, and that will drive demand for housing. But I think 3 of those 4 drivers are not going to be as strong as they have been in the past. And what that means is we probably can't overall expect property prices to rise as rapidly going forward as they have in the past. If we look at where we are now, though, the level of demand for housing is really, particularly in WA, really strong and surprisingly slow given how quickly interest rates have gone up and how much borrowing capacities have decreased as interest rates have risen. In some markets, we've seen a bit of an increase in the stock for sale. We've seen a bit of an increase in new listings, but price growth this year could actually end up being, by the end of the calendar year, stronger than what we saw last year, and certainly stronger than we were anticipating when we did our forecasts at the start of this year. If there continues to be a little bit more new supply coming onto the market, it's hard to know now, but potentially that will take some of the fear of missing out in the market. But WA is a bit of an outlier here because the volume of stock for sale is so low and there's such little choice for buyers and there's so many people wanting to buy into that market. But I think still vendors need to be realistic on price because if there is more stock, buyers can be a little bit more selective, or they might be more willing to wait and in the anticipation that something equally good or better comes onto the market in the next few months. That high cost of new housing. Now, the gap between the cost of new housing and existing housing is narrowing much quicker in Western Australia because price growth is much stronger, but there's still that premium, and that still means that people have a preference for an existing home over a new home. It also means that people have a preference for a home that doesn't need renovation as opposed to one that does. I talked a little bit about the need for more infill housing. Obviously, there's not a lot of medium and high density in Perth, but I think there is a need to try and inject some more of that density into those established suburbs. And I think the high cost of renting, even though it's going to cost people more to take out a mortgage, the state of the rental market, which we're going to get into next, is going to drive more and more people to want to become first home buyers just to escape the uncertainty in the rental market and have that own place that, they can't be turfed out of, and, they're not going to get slugged with a 20% increase in their rent. Yes, there might be interest rate changes, but it does give someone a lot more certainty. Now, looking at the rental market, over the past 3 months, you can see house rents in Perth were unchanged and unit rents were up 3.4%. Some really strong increases there over the past year. Units in Mandurah up 16.3%. Units in Bunbury rents are up 15.4%. The Perth inner suburbs now looking at $900 a week to rent a property there, a house, $950 a week to rent back in the outback north. Kind of getting back up to the prices we were looking at in the mining boom, although not quite that high yet. This is how much rents have increased over the last year: 18% in Perth, 11% in regional WA. Perth is now more expensive to rent than Melbourne, more expensive than Adelaide, Hobart, Brisbane. The only markets where it's more expensive to rent than Perth now are Sydney, where it's about $710 a week, and Canberra, where it's about $650 a week as well. Where have we seen the strongest rental growth? Now, it's been strong right across the state, but the strongest growth is in the northeast and the southeast. Probably not intuitively where you think people would be renting. And this is something we're seeing right across the country. I think it's really a reflection of people where they really want to rent, they can't afford the rent there anymore, so they're pushing out into some of the more affordable rental areas. If we have a look at house rents versus unit rents, so house rents were up 12% in Perth. Unit rents were up 20% over the past year. And then regionally, house rents were up 12%, unit rents were up 18%. So I think what's happening is people are getting priced out of the house market for rents and they're going back into units as a cheaper alternative. If we have a look again at like the chart we looked at for prices over the last 5 and 10 years, a very similar story. So in Perth, rents are up 86% in the last 5 years, but extend that out 10 years, rents are only up 45%. Not as severe in regional WA, but rents are up 85% in the past 5 years, 61% over the past 10 years. So yes, rents are growing really rapidly at the moment, but it's coming off a really weak period over the previous 5 years and really over the previous 10 years to that. So that gives you a snapshot of what's happening. Rental returns are still really attractive. Now you can see that they're starting to roll over and come a bit lower. But Perth units, a 6.5% rental yield and a 5.2% rental yield in Perth houses, plus the fact you're getting 20% price growth on top of that. It's no wonder that we're seeing investment in the WA market ramp up quite substantially over the last couple of years. And then looking at rental supply. Now, interestingly, the last few months, we have seen a bit of a lift in new rental listings. They're up 13.5% from a year ago. They're still below that 5-year average by about 8.1%, but you can see Mandurah in the southeast, quite a big increase in new listings. Bit of a different story regionally, a bit of a rise in the outback south and Bunbury, but falls elsewhere. But total rental listings, again, a bit higher than they were a year ago, but on a historic basis, there's still not a lot available for rent. Total rental listings are down 35% compared to that May 5-year average, and they're comfortably lower across each region of the state. So yes, maybe there's a little bit more rental stock available at the moment, but it's still a very tough market out there. If we look at rental inquiries per listing, we have seen a reduction in inquiries per listing, partly volume of inquiry, partly that there's more stock. But again, go back and have a look at the number of inquiries per listing pre-pandemic. You were getting about 12 rental inquiries in Perth. You were getting about 5 in regional WA. You're now getting 33 in Perth and you're getting 13 in regional Western Australia. So yes, maybe things are easing off slightly, but it's still a really tough, tight rental market with a lot of competition. And you can see that when you look at rental vacancy rates as well. You know, before the pandemic, you were looking at 3.5% to 4% vacancy rates. You've got a 1.2% vacancy rate in Perth at the moment and a 1.6% vacancy rate regionally. And that Perth vacancy rates, the southwest and Mandurah, much higher rental vacancy rates than we're seeing elsewhere. Days on site is 17 days compared to 16 a year ago. Over the 5 years to 2022, the average days on site for a rental property was 29 days. So we're sitting at about half what was typical. So again, just reiterating that the rental market is extremely tight. Bit of an increase in days on site in Mandurah, but everywhere else pretty flat over the last 12 months. So really challenging rental conditions in Perth. Where do we think the rental market's going over the next little while? So we have seen rental prices climb significantly. There's a few factors driving this. During the pandemic, average household sizes shrunk. You know, share houses broke up. People moved out of the city. What we've seen over the last last year or so is that the average household size initially started to increase again, but it's actually flatlined off over the last 6 to 9 months, lower than pre-pandemic levels. So if you've got smaller household sizes, you've got more people, you need more houses for them or more properties for them to live in. We've seen very low levels of new housing construction, and we've talked about that, labour costs, shortages, financing costs, and at the same time, rapid population growth. And in Western Australia, it's come from overseas and interstate migration, and that drives more demand for rental accommodation too. We've seen rents increase at a very rapid pace over the past year. The problem for renters now is the capacity to pay. Now, we think that rents will continue to climb, but probably not at the pace they have, just because people simply can't afford to pay some of the prices that the landlords are seeking. How do people respond? You know, we're seeing stronger demand in outer areas of the city. So people are moving to what might be deemed as less ideal locations. They're moving into smaller properties. So if you're in a 4-bedroom house, it might be a 3-bedroom house or it might be a unit. We are seeing stronger rental growth for units in WA than we are for houses. And what we're also seeing a lot of is people going back into share houses. Now, that's probably not out of desire, that's out of necessity, and we'll probably see more of that going forward as well. How do we address this? So the rental problem we have at the moment is both a supply and demand issue. On the supply side, what can we do? If we fixed everything that was stopping new housing supply today, it would still take 3 years to build that. So it's a long, slow burn to increase supply. The best thing you can do is get more people investing in residential property. And if more people are investing, that means you have more rental accommodation for the people that are living and coming into your state. On the demand side, what can you do? Well, the federal government has talked about lowering migration. That is very difficult to implement. The number of spaces for overseas students at universities are uncapped. As long as there's demand, there's basically a space for them. You can also increase rental assistance, which the federal government has done for each of the last 2 federal budgets, but that was after 20 years of not changing it at all. So it's long overdue, but there's probably more to be doing there. The other thing you can do is try and assist or encourage more people that are renting to become first home buyers. And again, state and federal governments are trying to do this with varying degrees of success. But I think generally, even though I think rental growth is going to slow, we're likely to still see rents rise in Western Australia, low double-digit figures over the next 12 months. That will encourage more investors into the market. And I think that tight rental market is going to encourage, where possible, some of the renters to exit the market and purchase their own home rather than staying in a really tight rental market. So that's the end of my presentation. I'm going to stop sharing my screen and I'm going to try and answer any questions we may have. There is going to be a poll flash up on screen, so if you could answer that, that would be really useful. But let's have a look at any questions that have come through. Drew's asked if we can get a copy of the slides. They will be sharing them afterwards. And doesn't seem to be any questions in the Q&A or in the chat, but hopefully this was valuable for you, and hopefully you can take some of what we've discussed here today when you're going and talking to vendors and potential buyers and give them the real broader economic context, but also the context of what's happening right across WA. Oh, there's a question. Do I have a 5-year outlook? Look, it's very hard to even forecast 12 months ahead, but in terms of the 5-year outlook, look, I think that we will see a deceleration of price growth from where we are, but I think that the Perth and WA housing market still has, a really strong affordability advantage. People are getting more opportunities to work remotely, which is going to help a market like Western Australia. Obviously, there's a resources sector which is really strong as well. So I think over the next 5 years, WA, probably for the first 2 or 3 years, will continue to be one of the best performing markets. And then things might start to taper off a little bit after that. I think there is a question in the Q&A. Where can we find a recording? We are getting a typed answer to that, which has just happened. Any other questions in the chat? Do you think net migration into WA is slowing? I'm assuming you mean net interstate migration. So net interstate migration has pulled back a little bit, still very high. Net overseas migration probably peaked in the September quarter of last year. As I mentioned, the federal government is trying to slow the rate of net overseas migration through a few different levers. So I think that will slow as well, but I think overall you're still going to see quite a lot of people coming into WA and quite a lot of people needing housing in Western Australia at the moment. There's a question, sorry, back a little bit further. Is there room for, now they're all jumping. Is there room for unit prices to move further up? I feel like they're still behind. Yes, I think so. And I think as people can't afford houses, they do make that sacrifice and they go to units or they go to townhouses. I guess the challenge in Western Australia is that the unit market is nowhere near as mature as it is, particularly in places like, New South Wales or Victoria. So there's probably demand for it, Whether there's enough supply is probably the bigger question. The other challenge is a lot of the new units being built at the moment are not necessarily affordable. They're very much targeted at that owner-occupier segment of the market. Do you think there will be negative growth in the next 3 years for a quarter? I'm assuming you're talking about price growth. Look, I think the market's going to continue to see price rises. We sort of only forecast out 12 to 18 months. I think for the next 2 years, we'll continue to see prices rise, but I do think that rate of price growth will start to decelerate. Next 3 years' time, we could see a weaker quarter for price growth. Ben's asked, what is the average time for someone immigrating to buy a home? So the ABS puts some stats out about this. It typically takes more than 5 years for someone that migrates, that's here temporarily, to purchase their first home. So it does take quite a period of time. I guess you need to move here, you need to make sure you like it, you need to find out where you actually want to live, and then you make that decision. So the time from someone arriving to actually buying is quite elongated. In WA, is there any stats on what percentage of interstate migrants are staying in Western Australia? So the state, the national, state and territory population data does have a breakdown of the number of people leaving WA versus the number of people coming to WA. At the moment, you're obviously getting more people coming than you are leaving, and it actually breaks it down by state as well. So it's hard to know when people come, what percentage of them actually end up staying. That's not something we really have much visibility on, sadly. Looks like there's another. So there's 2 questions in the Q&A. What is your outlook for areas like Albany? Look, I think the Albany market's going to continue to be quite strong. There's a strong push for lifestyle. That market is relatively affordable. It's a great part of the world. So I think that market's looking quite good. And we're seeing, even though there's not as much talk about this flooding to regional areas, we're still seeing really strong demand in a lot of regional areas around the country. We then got a question from Jamie. From a turnover point of view, which is of particular interest to real estate agents, how are we performing year on year? That is a good question. I don't have that on hand, but we can possibly take that offline and have a look, or have a chat to your account partner. I'm sure they've got some information that they can share with you about that. Jumping back to the chat, just to see if there's any more questions there. Doesn't look like it at the moment. Well, hopefully I could answer some of your questions. I know some of them I couldn't. But hopefully that was really valuable for you, and thanks for coming along today. And I guess good luck for the next 6 months, and hopefully the market's kind to you. Thanks very much.